If you're operating your own STRs and you're getting good at it, you may think the next step is to start offering co-hosting services to other short-term rentals in your area. This would turn your cost center into a profit center, right? I've advised over 1,000 real estate investors one-on-one on how to grow their portfolio, and I've seen some do this successfully, while some have wasted hundreds of hours and lose tens of thousands of dollars in opportunity costs. And so in this video, I want to break down when you should consider spinning up a co-hosting company and when it's not worth your time. I'm going to show you how to decide if co-hosting is the right next move for your business, how to pick the right properties and avoid the wrong ones, and turn your current STR operation into a multi-property income stream without buying any more real estate. So what is short-term rental co-hosting? Simple definition, it's managing someone else's short-term rental property for a percentage of their revenue. Now, I've seen co-hosts charge anywhere from 15% all the way up to 25% of their gross revenue, depending on how good of a manager they are, and also the property qualifications and specifics. Co-hosting is a step down, I would say, from like full-on property management. And in some states that you're operating in, you actually need to have a property manager's license to be a property manager, versus co-hosting, because it's a step down from property management, full-on service. You don't need a license in every state to be a co-host. So your role normally as a co-host is to handle everything from listing optimization to guest communication to maintenance and coordination with the cleaners, the handyman. We talked about the guests. Like, your responsibility is to full on generate as much revenue out of that property as possible with the least amount of bookings. You want to drive maximum ADR, maximum value per night, with the least amount of bookings, ideally. And the revenue model, pretty much, you're going to be taking a percentage of that gross revenue that you can generate for your client. Now, I'll let you in on a little secret when you're trying to get co-hosting clients is you should know that market really well. And so you want to start with leverage of that you have in your local market expertise, right? So if I have 5 properties in Gulf Shores, Alabama, and maybe some of them are on the water, some of them are a little bit far back, like, I should know exactly what those houses near me or my houses are doing. So then I can go to somebody and say, hey, look, like, I know you have a property on this street. How much money are you doing? Okay, 80 grand a year. Well, there's properties on that other street that I have that are doing 110, 120,000 a year. And maybe I can help you manage that property so that way you can generate $120,000 in revenue as opposed to only $80,000 in revenue. So leverage your existing systems. You already know how to run Airbnb listings. You already have the co-hosting systems in place. You have your cleaner and your handyman and your network of contractors established. And the most important thing that you have to do is turn your cost center into a profit center. This is some of the best business advice that I ever got, was to turn your cost center into a profit center. So if I'm somebody that has, say, 5 properties, okay? So on average, let's say I spend $10,000 in cleaning per property, and I have different cleaners in each property. I'm spending 50 grand a year just on cleaning alone. Well, one thing that I can do to lower the burden of the cleaning costs is if I can go and grab 4 or 5 other properties from my clients that I do co-hosting for, now we can share in those collective resources of the cleaning companies, and I can charge my co-host client a markup fee on the cleaning, and hopefully that fee will be enough to cover some of your cleaning costs as well. So you could get to the point where you might own 5 of your own properties, okay, in a certain market, and you manage maybe 15 or 20 of other people's properties. At that point, you're pretty much getting your cleaning and your handyman costs for your properties are going to be covered by the spread between what you're charging the cleaner and the handyman and what you're billing to your co-hosting client. So it's a great way to turn your cost center into a profit center. Cleaning, by the way, is going to be people's biggest line item expense on their short-term rentals next to like your mortgage, right? So like cleaning is always the second largest expense that you're going to have next to your mortgage. And if you can find a way to reduce that, you're going to be successful in this business. If you want help setting up your business the right way, or just making sure you're not leaving money on the table, click the first link in the description and you can book a call on the next page. Now, co-hosting can be a solution for people who are constrained by debt to income. So imagine this, like you're a W-2 worker, you buy a couple properties, 2 or 3 properties, and a lot of us have kind of read like the Brandon Turner books, you know, you can buy 10 properties in your own name conventionally. But with short-term rentals, because we're buying properties that are on average 2 or 3 times greater than that of a long-term rental, we're going to max out our debt to income very quickly. Most short-term rental investors, the reason why they can't scale past 2 or 3 properties is not because they lack knowledge. It's not because they don't have the systems in place. It's not because they're not good investors. It's simply because they don't have the proper debt to income when they go to file their tax returns. And co-hosting can provide a great cash flow for you without adding any additional debt to your portfolio. And most importantly, it keeps you in the game in that local market. It keeps you in the game of knowing what's going on in that market if you're going to have local market expertise. So like I might cap out at 3 or 4 properties on my own, but then I'm going to go and try to manage 5 to 10 properties of other people's in that market so I can stay in the game. And that's what's also is most important. It's hard to quantify that dollar-wise, but I promise you it's very important. I had a client, she owns 5 or 6 properties on her own in 30A Destin area. I gave her this advice over a year ago, and now she manages 25 other properties for people in that area. And these properties in Destin and 30A are all high revenue properties. Each one of these properties is grossing at least $100,000 in revenue. So now she's able to share in the cost of her cleaning, of her handyman, of her contractor fees with the other properties that she manages. And now she's pretty much getting her cleaning and handyman costs covered because she's sharing in the costs and resources of the collective portfolio between her properties and the properties she manages for. Now, that being said, there has to be a potential for higher hourly returns compared to what you're making at a job. If I'm a W-2 worker, let's say I'm making $200,000 a year, assuming that I'm working 2,000 hours a year, my hourly rate is $100 an hour. So you have to make sure that whatever properties you're going to be managing, that you can earn an equivalent or an even higher rate for managing those properties. So if I'm managing a $100,000 gross revenue property and I'm charging a 15% annual fee, I'm going to make $15,000 before any expenses, right? Now, with a co-hosting company doing tax returns for clients, the expense ratio, I would say to expect in like your first couple of years when you're just getting started is going to be probably a lot higher than that when you continue, because that first year you're kind of like setting up all your systems, you're getting your name out there, you're going to incur more marketing costs than you will in the future. And so your expense ratio in the first couple of years might be like 40 or 50%, meaning if you gross $15K in management fees, you're probably going to end up keeping like $7,000 of that. But as you grow and as you scale and you add more properties, think about it. The PMS systems all cost the same. It's the same software. The relationship between your contractors and your handyman and your cleaners, it's all the same cost. But the more properties that you add on into your systems and the more revenue you make, that's where we've seen people's profit margins for coasting and property management get in the 60 to 70% because they have economies of scale. So there's a lot of factors to consider when it comes to should you start a co-hosting company. First, we have to consider, are you doing this because of your debt to income and you want to stay in the game? Are you doing this as a way to reduce costs in your overall portfolio, like cut out some of your cleaning costs, cut out some of your handyman costs? Are you doing this to get away from your W-2 job? Like maybe if I'm making $100,000 at a W-2, well, I only need to find 5 properties that are grossing $100K in order to make that same amount of money that I could be making at my W-2 job. And those 5 or 6 properties is a lot less work than 2,000 hours a year. You can potentially earn more than what you're making at your job if you're doing co-hosting. Real quick, before we go any further, if you're running STRs or thinking about co-hosting, don't overlook the tax side of this. Most investors only think about their cash flow and revenue splits, but how you structure these deals can have a huge impact on your tax bill. My team and I work with STR investors all over the country, not just to file your tax returns, but to build proactive tax strategies that help you keep more of what you earn, especially as you scale into co-hosting or adding more doors. Here's where co-hosting makes sense. You already own and successfully operate short-term rentals. You have established systems and vendor relationships. You're looking for additional revenue streams, and you really understand the STR business model, but that is not enough. You have to target the right properties. Ideally, you're focusing on higher revenue properties, maybe $75,000 or $100,000 a year annually. And that's where you're going to calculate your effective hourly rate for managing other people's properties compared to your W-2 income. And don't take on properties that are less than your current hourly rate. And here's when you should not be co-hosting: those lower value properties. You don't want to manage a bunch of properties that are only grossing $40,000 or $50,000 in revenue, because you're only going to get 15% of that. and each property is going to require a certain amount of hours to manage each year. You want to make sure you're maximizing the amount of money that you make per hour spent. Now, here's something that I've heard before from clients. Ryan, I want to manage so-and-so's properties in my area, but I don't want to make the property worth more because I want to buy it. And if this is you, here's exactly what you need. You need a purchase option agreement. A purchase option agreement allows you to pay right now for the right to buy the property at a set price in the future. So an example might look like, I give you $10,000 today for a 2-year option to purchase your property for $300,000. So you're getting $10,000 today for me to buy your property in 2 years, within 2 years at $300K. So after 2 years, if I'm managing your property and I'm boosting the revenue on the property, making it worth more, and now it's worth $400,000 instead of $300,000, I have the option to buy your property at $300,000. And then my net worth would go up $100,000 in one day because I'm buying it for $300,000 and it's worth $400,000, right? So if the property appreciates, primarily because I'm the one that's managing it, I have the option to buy it. If for whatever reason the property doesn't appreciate, or maybe not as much, I have the option to just let the lease lapse. So that's something that you can do that's like pretty technical, where if you want to manage people's properties, but you don't want to boost the value of them because you want to buy it in the future, consider the purchase option agreement as a way around that. So the bottom line is, if you're already successful running short-term rentals, cohosting can be a natural extension to that and allow you to earn more income and have better local market expertise. So you have your existing systems, your local expertise, and the right property selection will lead to a profitable co-hosting business. And it's about turning your existing knowledge and systems into multiple revenue streams. Hey, if you like this video, you're definitely going to like the video here. Check it out, and I'll see you over there.